I can't take no loss. I don't even know what it costs.
Hi everyone and welcome to the channel. I'm the Conscious Day Trader, and today we're going to make a video about the easiest way to trade an ICT setup without knowing ICT, without going through the 2022 mentorships. Everything will be in this video, so you can take this video, literally go and trade this afternoon in the New York session or the London Open. Super useful. By the end of the video you'll have everything you need for a simple setup so you can go out there and make some money. The caveat to this is obviously this is not replacing all the incredible work that ICT is doing, but obviously a lot of people are not getting it. Some people get it, some people don't. So I wanted to make a video with, regardless of if you can push through all the library that he's created, just to make you a simple way to find buyers, find entries, how to execute, and how to deal with trades. And all this is going to be in here. So make sure you subscribe, like the channel, and let's jump straight into the simplest way to trade ICT concepts without having any knowledge of ICT. Okay, here we are. First of all, the first thing that we're going to do on TraderView is find, we're going to do this on Forex. Why Forex? Because Forex allows for a little bit more flexibility when it comes to getting things wrong. The price bounces a little bit more, it's a little bit kinder than indices like the DAX or the S&P. When you get it wrong, sometimes you'll be able to get out of these trades, and I will show you the basics of this, which is I call repositioning, and it's a pound average approach, and we're going to look at that the basic level. So if you don't have any knowledge, what are we going to start with? First of all, I'm going to do this analysis on a new chart. So we're going to grab here on the top right, we're going to go into our watch list. I have created a watch list of all my currencies. What I'm going to do is going to open a new one though. So we're going to do a pound dollar, but not the one that I've been using because that's got all my analysis on it. I want to go on to the pound dollar from Rwanda. You can do that and have the same data on there. First of all, what we're going to do is we're going to have two things that we need to put on the chart. We're going to have previous dailies, the highest level on the day, previous day and previous low, and the previous weekly level and low. We want our main aim with bias is to identify if the price is in discount arena or is it in premium arena, and then we're going to do something with it. So we're going to go straight on the weekly, and all we're going to do is just line up the chart, and we're going to look for the most obvious high and low. If you take the price and go backwards, where is the most obvious high and low? The most recent in terms of weeks. We don't want to go years back, we just want to go the most recent high and low. And you will find that it's quite obvious that the most recent swing high is up here, and the most recent swing low is going to be down here. So I'm using my command on a Mac to make it magnetize, and that has given me now an arena of the high and the low. What else do we need to know? We need to know how far we are from these lines in terms of the midpoint. The midpoint, we're going to put a horizontal line, and in order to find the midline point, we're going to get a Fibonacci tool, and we're just going to go from the low there, this one, I'm just going to put it to the side so I can see it, to the top, and the half point of that will give me the 50%. Look at that, how close I was. So we're going to line that up to the 50%. And what I like doing is labeling these so I know what they are. So I've saved some setups here. I normally have it for the daily, but all I'm going to do is double click on that, go on text, and change that to a weekly. Then we're going to do the same for, you can change this to whatever you want as a design. I like these as written below, green and red, because one is showing selling and the other one is showing anything below this 50%, which we normally call equilibrium. You can call it whatever you want. This is where the price is the half point between the weekly high and the weekly low. So we can see that this price is trading above at this moment of time. So that means we're in premium arena. And what I mean by that is any price that is from this line to here is going to be premium. And we can type that in, premium, anything below discount. Pretty simple, right? We can even change the color. I don't want you to do this. I'm just saying that. I'm just showing you how what discount and premium looks like. So we can go on style and change the background to green. So when the price is down here, we're looking for long opportunities. When the price is here, we're looking for short opportunities. As simple as that, guys. That's all we're doing. The closer it is to equilibrium, less risk we can apply, because we might be in premium, but we're actually close to equilibrium. The more further away we are from equilibrium, the more risk we can take in terms of increasing our size, or a little bit our size. We can have more conviction that this can be an opportunity for us to get 10 to 15 pips. So we've done that on the weekly. Now what we're going to do is do the same on the daily. Here we are on the daily. We can see our premium and discount, and look how small the candles look compared to the weekly. So we're going to go on the weekly here. On the daily, we're going to do a different approach. We're not going to look for the optimum high and optimum low. We're just going to go to the previous day, which today is Wednesday. So we're going to go on Tuesday's date, and we're going to do the same exact thing. We're going to grab our horizontal ray. With our command, we're going to magnetize it on the high of that day, and we're going to label it daily high. And we're going to do the same for the daily low. And we're going to put that there. Now, what else we're going to need to do, like we did on the weekly, is find the midpoint. So all we're going to do is find that point there to that point there. And we're going to zoom in to find where what do we need to put in? We called it equilibrium. So we're going to grab equilibrium, and we're going to grab a horizontal line. We're going to label that equilibrium because I've saved it. And now we have a really nice chart where we can look at what's going on. Have we looked at any ICT concepts yet? No, because we're actually looking for where price is in relation to our bias. So if we are wanting to be short, all we're going to do, we're going to wait for the price to be in red zone, so premium price of the weekly and premium price of the daily. That would mean the price would have to come above the daily zone. Okay, so both our daily analysis will be red, and both our weekly analysis will also be red. So now we have two indications that are telling us that the price is at premium zone with regards to the weekly conditions. This is only for bias, guys. We haven't looked at entries yet. We're going to look at that, but all we're looking for is for the price to be trading either in the red or the green. If it's in the green, we're looking for buys. If it's in the red, we're looking for shorts. As we can see in this current situation, now we will be looking for a short opportunity on the pound dollar. Now, how is this? Do I just go and jump in and just short it because the weekly is at premium arena? No. What we're going to do is we're going to go now down into our trading arena, which will be our 1 hour. And then what we're going to look for is for the price to do two things. If we are trying to short, we are only going to short the price if it's above the previous daily high. Is that hard? It is hard because we're going to have to wait. But in terms of actually actually trading this, all we need to do, we don't have to look at this chart. All we need to do is this price has to come up here. When it comes up here, then we can look for something that's called a fair value gap. Okay, this is the only thing that we're going to look at. And there's two things that we're going to look at in terms of ICT. Without you going through all that, all we're going to look is taking the low, which will mean a break of structure. And I'll show you this in detail, and a fair value gap. And very easy to recognize, but step by step, what do? We jump on our weekly. Where is our price? Okay, our price is in red. So that means I'm looking for shorts. How far is it from equilibrium? It's not that far. Well, ideally it would be up here, right? So I need to be a little bit more frugal with my positioning. If I normally trade one lot, I'm going to half that lot position. So if I'm trading one lot up here because it's at extreme premium, right? All I want to do is divide this into how many times my risk wants to be. The closer we are to equilibrium, that will be small. If you want to do, let's say 3, and you can do it like this. If the price is from equilibrium to here, we're going to take a box like this, and we're going to make it a fancy color, like so we know it's not, this is for our position now. And just roughly 3 boxes that fit into our premium arena, right? And right there, I can't believe it, I nearly got it exactly right, just randomly. Okay, so we have our 3 boxes. So if up here we trade 1 lot, here we can trade half a lot. If we're close to equilibrium, we can trade 0.25. Why? Because we are close to equilibrium. So even though we're in the red zone of premium, we are not that far away to be able to be confident that this is a very discounted arena. And this is a nice little tip that you can use. Just break 3 boxes within the arena of premium. The closer you are to equilibrium, you're going to take less risk. The further away you are, especially around the previous weekly high, we can take a little bit more risk in terms of your normal size. So if your normal size is 1, you take 1 lot. Same applies for discount. The further we are below discount, the more we're going to be, and I took that from that equilibrium, but it's actually this one. This is the equilibrium for the week. So we'll do our 3 boxes from here, 3 boxes from here. Wherever you are, that will determine your risk. Okay? Simple stuff. So what we're looking for is red box will give me selling, and price has to be above the previous daily high. If I want to buy, this price has to be in the green zone, and it has to also be in the previous daily low, right? Simple stuff. That is your bias done. Don't worry about anything else. Okay? You might say, look at British pound. If I wait for these 2 conditions to happen, it will be ages. That's why you've got another 6 to 8 majors that you can go and do the same thing on all of them. And the good thing about TradingView is you can just click on this plus button and you will put an alert system. Every time the price passes my previous daily high, I want you to alert me. And even better, I can just click on the line and just put an alarm for the line. Every time it goes to previous daily high, give me an alert. Great. So now we're set. We've done this for all our major pairs. So Aussie dollar, Euro dollar, USD JPY, CAD JPY. All these are great pairs. Go and look at the major pairs and do it on all of them. Just put your alerts in and just wait. Wait for the price to go to a premium arena. And the best conditions, your alpha conditions, would be when you get that top box, because it will be way up high in your previous weekly high, which means we're now in very premium arena. And we're also looking for a break above the previous daily high. We have those 2 things, confluences, and then we're looking for opportunity to go short. Okay, so now we have all that. How do we actually trade it? Now let's say where we have our conditions, right? We found the pair, we did all our analysis, and we found our pair, and this price is now breaking the highs. If we go on a 15-minute, we're very close to the high, we got the alert, and we want to be shorting this. Why? Because our weekly is in the red. If I click on the weekly, we're in the red. And if I go onto the 15-minute, we're very close to previous daily high, so I can actually take my full lot position. And I'm only looking for 10 to 15 pips, okay? We need to be very frugal with trading. We don't need to be greedy. So we're going to wait for that to break the highs. Why? Because in ICT concepts, there's a thing called liquidity. We want to have a liquidity grab. You don't need to know this. All you need to know is that we want this price to go above any other previous price which is in the proximity of our previous daily high. And you can do that by putting some arrows on it, and you can put that there. And if the price breaks that, we have a valid trade. Okay? Simple. Let's see what happens. Price hasn't broken the high yet. There we go. We have broken the high. So now we're looking for opportunity to go short. Now we can be, if we are, for me personally, if it is at this high area, we're in the red zone, we're high up in the weekly, right? We're not as now where we're close to equilibrium. I would just take an entry there. I wouldn't wait for the confirmation, because I know It's so high up in discounted premium arena in the weekly, and it's also above the previous daily high. But because we are very close to equilibrium, which means we're only trading 1/3 of our normal size, I'm going to wait for confirmation. And what I need to wait for confirmation, it means that we need to break the closest swing low. That's all we're going to do. We're going to wait for the closest of swing low, and then I'm going to show you something on how we're going to enter, which in the ICT world they call a fair value gap. We had a spike up, and that's sometimes why it's good not to get involved, because I might be able to handle this, but new traders won't be able to handle this heat. So we're just waiting to see what happens. Price has gone up, it's dragged all that liquidity. Now, where is the closest swing low? It's here. So we have to wait for a swing low below here to be breached. Nothing yet. Okay, now we have a new swing low here. So what do we do now? We'll put my line to that level there. What we want to see is a break below that level. Hasn't breached yet. Now the closest swing low is this one. Now we have a swing low that has been breached. The only thing that we also want it to happen is we want to see this body of the candle, not the wick, not the line, the body needs to be below this line. Okay, let's see. And this is the candle that closed below. So now we are interested. Now the other thing that how we're going to get an entry, we're going to get an entry with something that's called fair value gap. So from the close of the candle, you're going to go to the highest point of that candle. Okay. And I want you to put a box from that high point to the previous high point. And if that box is formed, then you would have a fair value gap. And a fair value gap would be the price on right and left of the main candle before not having any data right or left of it. And what I mean by that, you can see an example here. This candle here has data on the right and on the left. But this part of the candle here doesn't have data on the right and the left. So then I can put a box on that, and I like labeling it fair value gap so I know what I'm looking at. Right there. And I normally label it on what I'm looking, so that would be a 15-minute fair value gap, and we've got that there. So all we're doing now, we've looked at our bias, we were patient enough, not getting in, we got in confirmation of a break of structure, which is taking the low closest to the swing low, and now all we're going to do is for price to come in and tap us in. So what I'm going to do, I'm going to put an order there, and I'm going to wait for it to tag me in. Let's see if it happens. It does. Look at that. It taps us in there. We get triggered on the order, and then that delivers. We're only looking for 10 pips. So we're going to drag this down to 10 pips. Okay, and that was a successful trade. Now, if you continue, you might say, why did you not keep the trade on? Well, look at that. It just came back and maybe you stopped out. 10 pips I find as a scalping opportunity, and even as like a beginner trader is a very good measure, because it allows you, even if you get your analysis wrong, sometimes it will give you 10 pips before it moves. Obviously what it did here, it came and filled the whole fair value gap, and then it came down again, and then it continued lower, right? But we don't look for this as beginner traders. We're looking for 10 pips. This is more than 10 pips. This is an actual, from the fair value gap, is 50 pips all the way to equilibrium. But we're not going to worry about that. And there you have it. Just to summarize, all we're going to do is look for the weekly high and the weekly low. We're going to put a premium and discount arena. We're going to go on the daily. We're going to put a previous daily high and previous daily low. When the weekly aligns with the daily and how close it is to equilibrium, that's going to determine our risk and how much we want to put in. And then we had 2 terms from ICT that you learned without going through everything. Break of structure, which means breaking the low or the high if you're going up, or the low if you're going out of the closest swing. intermediate swing, which is the swing closest to the candles that you're looking. When we had a confirmation of that, we're just going to wait for that price to come back to what we call a fair value gap, which is a gap between the main candle that we're looking at, the previous candle, right data, nothing on the right side, nothing on the left side. We put a box on that, we call it fair value gap. If the price comes and touches the bottom of that, then we look for 10 pips. And there you go. That's the easiest way you can make money in Forex I think personally, because it's only price action. You're not looking at indicators. I did mention that we might show you some indicators, but I decided to make it really simple. If you do like this, make sure you comment below. And if you do want to add some slowly increasing with indicators and being fancy with silver bullets and looking at times on when you can get the best trades, let me know in the comments and I'll make a video about that like this. This is such the simple way you can trade, and it's logical. You can show this to any trader and they'll be like, that makes logical sense. And it's a valid way of trading. So you can have the confidence from a funded trader to take this and use it as your own. Is it going to work 100% of the time? I think it's going to have, depending on how close you are to equilibrium, that might be higher risk. The further you are to equilibrium and closer to the previous daily and weekly highs, it's highly likely that you'll be getting 10 pips out of that move. There you go. I hope you enjoyed it. Until next time, it's been the Conscious Day Trader working on a simple strategy on ICT without knowing anything about ICT. Go and use it, make some money, and I will see you very soon, tomorrow actually, on our live at 10 o'clock UK time. Come and trade with me.
I can't take no loss.